Welcome back to Alberta Primetime. To gain the same pension as an MP, an average Canadian would have to make contributions for 30 years. Thanks to a generous government package, MPs get there in just 6. The head of Canada's Treasury Board is mulling changes. Let's see what our Monday Money panel thinks. Jim Yee is a financial educator and founder of retirehappy.ca. Russ Stratwa is an investment advisor with Canaccord Wealth Management. And Shafik Hirani is a director and senior executive financial advisor at Investors Group Calgary. Good evening, everybody.
Hi, Jen.
Hi, Jen.
Hi.
The Canadian Taxpayers Federation says if the average Canadian wants a pension like an MP gets, they'll have to contribute $129,000 a year in the 6 years. An MP kicks in just $10,900 per year. So, Jim, let's get started on this. Exactly how does this compare to what most of us are receiving?
Well, I mean, it's incredibly lucrative. If you look at the best defined benefit pension out there, would be, say, a government employee. They're getting a 2% benefit. So if you work, the maximum benefit you can get is 35 years times 2%. That's 70% of your, call it, best 5 years. And so the funding on that, the big problem is the funding. So the funding on that, if you take an employer and an employee's contribution, you're probably putting in about 18 or 19% in order to fund that particular pension.
You mean the employer?
The amount of the contributions that go into the plan,
okay.
About 18, 19%. Usually the employee puts in half, the employer puts in half. So in this particular case with the MP pension, the MPs are putting in 7% of their income, and the employer is putting
Taxpayers.
in. Well, yeah, they're 10 to 25%.
Pretty rich.
So, incredibly rich. And so no employer would ever put this in if it were a standard employer, because it's just too rich, too lucrative.
Russ, is there a danger that such defined benefit pensions, and there aren't even a lot of them around, governments, unions, typically the only ones left, but of those that there are, is there a danger that there's going to even remain solvent? Are we going to see governments, as they're talking about already in Quebec and Manitoba, taxpayers actually having to bail them out?
Absolutely. It's becoming a society of haves and have-nots. More than 60% of people do not have these defined benefit plans. And most people don't begrudge anybody a pension. We all work hard. But it has to be fair. And the rule of 80 is a general rule of thumb where your age plus years of service, and usually works out to 20, 25, 30 years of service, not 6. So, I mean, it just gets to be absurd. And the more people become educated, but there's the key. People are not educated, there's not going to be an uprise.
Shafik, federal government departments are being asked to trim spending 5 to 10%. So the reason we're talking about this, the head of the Treasury Board mulling over trimming pensions for MPs. Russ makes a good point. We all know about it, yet where's the uprising? There's some anger out there, but we all just continue along. What's realistic? Are we going to see a trimming of this, or is it more likely that they'll simply trim what taxpayers are kicking in, maybe less than the 40-60 split that MPs are enjoying?
Yeah, it's really a tough read right now. The head of the Treasury Board, his name is Tony Clement, and basically he's been assigned the dubious task of reducing pensions. So what he has done, and what the finance minister has done, is they've frozen wages. Now, that won't even add a drop in the bucket as far as the pensions are concerned. The pensions are very overvalued, and you know, to go back to Jim's math, it's about $1 that an MP puts in for about $23 that a Canadian taxpayer contributes. I just don't know where the uprising is, because I think there's not just an apathy, but a lack of awareness as to how these pensions compare with our typical defined benefit plan and typical defined contribution plan. So the two types of pensions available are defined benefit and defined contribution. If you look at these government pension plans, not only are they a defined benefit, but the definition of the benefit is very high. And not only that, but it's in an underfunded situation. So that means in order to come up to current levels, the taxpayers are going to have to contribute more. And we're dealing with the biggest government in history right now. So it is something to be aware of as a taxpayer when you cast your vote.
But I do think it's an awareness issue, because you know, even somebody who's in the financial industry like myself, I work with defined benefit pensions day in and day out. Even I knew that the MP pensions were lucrative, but I did not know the complete math. And so reading this 65-page report was shocking to me.
And even when you look at defined contributions, defined benefits, you've got a lot of private sector employers now putting staff on self-directed RRSPs, and that's where the awareness really comes into play. The Governor of the Bank of Canada is telling us to save money, but you need to be informed and aware to not go broke with an RRSP these days.
Defined benefit plans weren't designed for modern day people. I mean, my father retired at age 60 and passed away at age 69. That was a standard. He had a great pension. Most people now are looking at retiring 50, 55. They're going to live to 80, 85, 90. So these companies are taking their risk levels off the table, but the government's not doing that.
So help us out with people that do need to manage their own RRSPs, most of us who aren't in those few lucky boats. Shafik, just quickly, it's a volatile time right now. It's a risky time. A lot of people are very bearish on stock markets for the next couple of years still. Your quick insight for people on managing their own RRSPs.
Well, again, it goes down to the awareness situation. If you take a look at Albertans, about 30 to 40% of Albertans don't even know what an RRSP is. They don't know what the options that are available to them. So you have to really take the bull by the horn.
So
and a lot of people are very skeptical. Yeah.
Okay.
I mean, it goes down to the basics. Get
Jim,
going.
Your best advice?
Be aware. Look at your statements. I meet so many people when you ask them, how's your portfolio doing? What's it invested in?
Okay.
I'm shocked at the number of times I hear, I don't know.
So address it when you first get it, not 12 months later after you've been losing for a year. Russ?
Put your advisors to work. I mean, they can set up a game plan for you that every December 31, you'll know the end result. You'll have your grade.
Next, the Bank of Montreal says 40% of Canadians don't know the difference between an RRSP and a TFSA. What you need to know about the tax-free savings account when the Monday Money Panel returns in a moment here on Alberta Primetime. Welcome back to the Monday Money Panel. A report by Bank of Montreal Financial Group shows almost 40% of us still don't know the difference between an RRSP and a TFSA. So let's get a little bit of help right now. Jim, first of all, are Albertans that misinformed? Is this typical?
I think it is typical, yeah. And I think the problem is that, with any of us, if we don't deal with this stuff day to day and it's not fresh on our minds all the time, it's so easy to lose information.
Yeah, so we'll clip the coupons for the 50 cents off the cereal at the grocery store and we won't do a little work on this. Russ, tell us what we need to know about TFSAs.
Well, the thing that I'm finding, if I can just add to that point, is it's more a motivation thing. I think people get kicked in the kneecaps enough time, they quit walking by that person that's kicking them. When you don't see any progress in your plan, your RRSP, you just don't take the effort. I mean, the last 3 years, a lot of my clients are making far more money in their investments than they are in their income, so they're becoming attentive. That's what I'm finding. There's a direct correlation. Tax-free savings accounts are one of the greatest secrets out there. RRSPs, people have to realize, is not a tax deduction, it's a tax deferral. You're going to pay the piper sooner or later. Tax-free savings accounts are just a great venue, especially for those out there that do not have a pension, which is 60% of the people or more. They need to look at alternatives. Might be a tax-free savings account, might be dividends, might be capital gains, or a little-known entity most people haven't heard of as a flow-through investment.
But I think the notion of a tax deferral can be actually misleading because the whole idea is understanding your marginal tax brackets, because the RSPs are probably more amazing than TFSAs if you understand the tax brackets. If you can put it in a higher tax bracket, then when you take it out, it's going to be better than a TFSA. I think the appeal to the TFSA, as Shafik had mentioned earlier, is that nobody wants to do anything long-term anymore. We live in the now society.
Because what's the idea, Shafik, about a TFSA? You're going to put the money in there. What are the limits each year? And for how long? Long-term?
Yeah, it's long-term, and also younger people can buy these things. So the limits are $5,000 per year, and they came out 4 years ago. So if you've never bought a TFSA, you can put $20,000 into these tax-free savings accounts. The investments between a TFSA and an RRSP are identical. So you can buy mutual fund stocks, GICs, annuities, bonds, that kind of stuff. So there's no difference in the investments. The idea behind the TFSA is you get a little bit more liquidity. You do not get a tax deduction, yet you get complete tax-sheltered growth, and you can take it out whenever you want. So a 70-year-old can buy it, an 80-year-old can buy it, whereas an 80-year-old cannot invest in an RRSP. So there are completely opposing investments.
Russ, TFSA versus RRSP, is there a place for both? Should everybody have one, or are there certain people who maybe not?
The key is, again, managing your income for your life. If you see a drop in your income, RRSPs are fabulous to fill that gap. If there's not going to be a drop in your income, like those that MLAs that have the great pensions, they should be looking at tax-free savings accounts, because there's no way to get those RSPs out at a lower tax bracket. So it all is based on your tax rate.
You do have to be careful. You can't put the money in, take a little bit out, and then put it back. It's the $5,000 per year.
Tax-free savings accounts, you can. You do have that liquidity. RSPs, no.
Except that you should put the money back in the following calendar year.
Right.
So that you don't get faced with the penalties. Yeah.
Can they be guaranteed? Can you buy GICs with them?
Absolutely.
Shafik touched on that a little bit.
Like Shafik said, the investments that you can choose, GICs, bonds, mutual funds, the investment lists that you have are applicable to both accounts, whether it's a TFSA or an RSP. And I think it's important for people to understand that for the majority of people, and that I sit down and talk to, it's not an either or. It's not a mutually exclusive thing, that many people should be doing both, quite frankly. And so I think that sometimes we battle out which is better. Well, they're both good, and they're both good for different reasons.
Russ, let's change gears a little bit. This is your real area of expertise. Calgary energy firms, Nexen, Encana, Talisman, seeing their stocks at lower values. Observers are saying that makes the target on their backs even bigger for a takeover. What's your take on the Calgary energy company scene?
Be careful about targeting companies for a takeout, because you never know if and when it's going to happen. And the biggest thing I find is that individuals are going to target companies that are broken. If they're broken, they're broken. Try and find a sector, perhaps, that is broken, and pick the best companies within that. As in the natural gas sector in Canada is one of the best. So that might be something. But with inventory rates at 5-year average, 17% above 5-year averages for natural gas, and this winter we're having, fabulous, it keeps on, but it's horrible for the natural gas sector. So how long before those inventory supplies decline? You might be in something for years
before you see a return.
So if you're going to go with that strategy, pick the best. Be careful it's not a broken companies. The fundamentals do have to take place.
Shafik, you're in Calgary. What's your take?
Yeah, you know, when it comes to these companies that are sort of potential takeover targets, they are the gas sectors, and gas trading around 250 with, like Russ and Jim were alluding to, the inventory levels are high. There's new technologies in SAGD drilling, so they are a good value. So if you're a long-term investor, I wouldn't pay specific attention to the individual companies, but I would go and look out and purchase what's a mergers and acquisitions portfolio, or a fund that specializes in mergers and acquisitions, because those funds tend to outperform the equity markets over the long term. So if you're going to buy an equity, the acquiring company is not the one that does better. It's the company that gets acquired. And they tend to actually outperform the markets if you can get in at the right time. Leave it to a professional, have a portfolio do it, buy a fund that specializes in mergers and acquisitions. Can't go wrong.
Jim, is buying individual company stock only, first of all, for those who are not faint of heart, and also for those who are well informed?
Well, I guess the answer is yes. I mean, if I look at my personal portfolio, I'm a big fan of ETFs, so I don't even buy individual stocks, and one would argue that I'm a, quote, sophisticated, well-informed investor, but 20 years, you know, the whole idea of trying to guess the markets, trying to guess which stock's going to outperform, which company's going to merge, I think it's a losing game. So I prefer to buy the market, pay as little fees as I possibly can, and keep my life pretty simple. Russ,
do you agree? Is it maybe just having the right guy in your corner, or gal?
I'd rather almost pay no fees, because managed money has had a suspect history. I'd rather know what I'm investing in, and the vast majority of my time is talking to those in the know of a company directly connected, so I can value. And I put the pressure on them to prove to me that this company's valuation is where it should be or higher. If they can't, then I stay away from it. If I can't prove to you that this car is worth X dollars, are you going to buy it? Of course not. And that's all you have to approach it with in the investment world.
Let's just quickly have a little bit of fun in our last minute of airtime here. Expenses, spending the company's dime. Robert Half International is releasing a list of unusual expense submissions, everything from pet food to hot tub supplies. You've got to wonder what some employees are thinking. Shafik, is it a matter of it doesn't hurt to try, or maybe it does hurt your reputation with your boss, your chance at promotion, your job security?
Yeah, not only that, but if you take a look at the companies that spend this kind of money, they have to account for these expenses, and often the people that spend the money are accountable to a board of directors, and if the board gets approval, they're not spending the company's money, they're spending the shareholders' money. So I think, you know, all in all, if it feels right and it sounds right, it's right. If it feels wrong, it's wrong, and you have a moral dilemma to do what's right.
Jim, do you think that people just feel nobody's really paying attention, I'll slide this or that in, get a sense of entitlement going?
I think everyone's trying to get the edge somehow, some way, in life, in work, in business, in money, and we're all trying to take the shortest path of least resistance. And I totally agree with Shafik. I think, you know, if it smells like a duck, walks like a duck, looks like a duck, it's probably a duck. So.
But Russ, finally, these are dismissal, can be grounds for dismissal, no?
Absolutely, but it goes back 30 years when it comes to taxes. For those that don't have the business account, it's the same for your taxes. If you can justify this expense was used to earn an income, then by all means. But if you can't sit in front of somebody, whether it's revenue agency or your boss, to justify that, then you're taking a heck of a chance.
Thanks for all of your insight tonight.
Wonderful.
Jim Mee is a financial educator and founder of RetireHappy.ca. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. And in Calgary, Shafik Hirani, director and senior executive financial advisor with Investors Group.